Suddenly, over a weekend, Lehman Brothers filed for bankruptcy, a headline that shook the world within hours. After 158 years of activity, one of the pillars of the global financial system collapsed. Along with it, assets worth around $639 billion disappeared into thin air. It was the largest bankruptcy in modern history. Within days, the shockwave reached Europe. Within months, families who had just celebrated buying their first home were forced to move back in with their parents. It all began with what later became known as the subprime crisis, mortgages given to borrowers with weak repayment capacity under terms that looked easy and tempting at first, but later turned into heavy debts that became extremely difficult to repay. This was not just a financial crisis, it was the worst economic collapse since the Great Depression. It shook trust in the global financial system, created a new era of doubt and uncertainty, and later helped set the stage for alternative ideas like Bitcoin. It also triggered a broad wave of mistrust that opened the door to conspiracy theories and the growth of extremist movements. And yet, most economists today agree on one point: this crisis was preventable. But how did mortgages that seemed normal on the surface become the spark that set the global economy on fire? 2008 remains one of the most complex and painful financial crises in modern history, and in a world that now faces economic tensions, trade wars, and financial instability, the signals of a new crisis may be closer than we think. To understand the present, we first need to understand the past. So let's start from the beginning, from a time when banking was simpler and more stable. In the 1950s, the relationship between a bank and a borrower was direct and personal. The bank knew the borrower's family, understood their income, and knew their real ability to repay. A loan was a long-term relationship built on trust. Profits were limited, but the system was stable and risks were controlled. And at the center of this system was housing, a symbol of social stability and family security. But that era did not last. New policies began that reshaped the entire system. With Ronald Reagan entering the White House, a fundamental shift in economic thinking began. Regulations introduced after the 1929 crash were removed one by one. The goal was market liberalization. The real outcome was an unprecedented rush toward higher profitability. And here, the first dangerous element appeared: mortgage-backed securities, or MBS. A mortgage was no longer a long-term commitment. It became a financial product that could be bought and sold. Over time, this transformation became more complex, and finance entered a completely new stage. In the 1990s, physicists and mathematicians entered trading floors. Financial products became so complex that almost no one fully understood them. But as long as profits kept rising, everyone ignored the risks building underneath. That neglect set the stage for a turning point that changed the rules of the financial system. In 1999, under pressure from powerful financial lobbying, the Glass-Steagall Act was repealed, the law that separated commercial banking from investment banking. Once it was removed, giant banks were born, institutions so large they were considered too big to fail. As these megabanks expanded, the hunt for more profit intensified, and the solution was found in expanding lending to groups that banks previously would not even approach. In the United States, every person who applies for credit has a credit score. It is a number, usually between 300 and 850, that summarizes your financial history. Do you pay your bills on time? Have you had late payments before? How much debt do you have? Do you overuse your credit cards? The higher your score, the lower risk you appear to the bank, so you receive easier terms and lower interest. But a low score means higher risk. Your application may be rejected, or you may receive a loan at a much higher interest rate. A simple common breakdown at the time looked like this: above 720, prime borrower, low risk 620 to 720, moderate risk below 620, subprime, high risk borrower. And an important point: subprime was not a type of loan, it was a description of the risk level of the borrower. For banks, this group was a massive market, a market that could generate huge profits, as long as they knew how to sell these loans and remove the risk from themselves. So this new market turned into a competition to offer bolder loans with easier conditions. Banks began issuing loans with no income verification, no stable job, and no real assets as collateral. Interest rates started low, but later became a heavy shock. It may sound like economic madness, but for banks, it was an extremely profitable model. The reason was simple: banks no longer kept these loans on their balance sheets. They issued the loan, bundled it with thousands of others, and turned it into securities that were sold to investors. So banks collected profit immediately, while the risk was transferred to others. As lending expanded, a housing boom arrived and covered up the risks. Between 2002 and 2006, property prices rose at an unprecedented pace, on average close to 13% per year. In a market that kept going up, everything looked safe. Even risky loans appeared harmless under the shadow of rising prices, and so a dangerous cycle formed. Prices kept rising, banks issued more loans, and risks quietly accumulated in the background. To hide the growing risks, an entire new world of complex financial tools emerged. Banks did not hold loans in their original form. They bundled thousands of loans together and turned them into securities sold to investors, a process called securitization. Risk no longer stayed inside the bank. It moved into other parts of the market, but Wall Street did not stop there. Those securities were bundled again into new products called CDOs. Then more layers were added. They were repackaged and sold multiple times, until it became extremely difficult to understand who ultimately carried the final risk. And all of it rested on one core assumption, that interest rates would remain low. Between 2004 and 2006, the Federal Reserve gradually raised rates until they reached 5.25%. As a result, mortgage payments surged and borrowers struggled to repay. Still, the financial system ignored the warnings. At that point, the crisis could no longer be hidden. On September 15, 2008, Lehman Brothers declared bankruptcy. The government did not intervene to save it, and no buyer could be found. It was an open declaration that the crisis had moved out of control. Within hours, financial markets froze. Banks stopped lending to each other. Companies could no longer secure short-term funding. Investors across the world fell into collective panic. What happened was not just the fall of one bank. It was the moment the foundations of the entire global financial system began to shake. But the real collapse was not measured only in numbers. It was measured in what happened to ordinary people's lives. Millions of families lost their homes after failing to repay mortgages. Around 8.7 million jobs disappeared over a few years. Savings evaporated, retirement dreams were delayed, and many people's futures changed permanently. This crisis was not just numbers on a screen. It was a social shock that hit an entire class of everyday people. After 2008, new rules were introduced, supervision increased, and stricter limits were placed on risk. But the essence of the system remained. Banks today are bigger than before. Financial instruments are more complex. Markets have returned to historic levels. Many names have changed, but the logic of fast profit and over-reliance on debt still stands. That is why the question remains open. Did we really learn the lesson? Or are we writing the same story again, in a different form? If you enjoyed this video, we would appreciate your support by liking, subscribing to the channel, and turning on notifications so you do not miss our next videos.